Okay, so we just went through the effect of making an extra mortgage payment and applying that directly to principal and how powerful it can be. Given the example, $250,000 home, 30-year mortgage, and an extra $500 a month going directly to the mortgage. Now, what I want to show you is taking that $500 a month and putting it in a vehicle that can help you gain wealth, using that money to make money and not tying it up in the real estate. So we'll flip our screen again. We're just going to show, this is where we left off, looking at this, two amortization schedules as they overlay to each other. I'm just going to move to the accelerated payment chart and going to use a whiteboard to kind of show you that both of these are like the graph that we just looked at. However, there's a couple other things at play here. So when you buy a $250,000 home, of course, you hope that it's worth a $250,000. And what happens is the longer you stay in that home, the more the real estate grows in value. So for this example, I just used the home value appreciating at about 5% year over year. Now, some markets are a little bit better, some markets a little bit less, but on average, we're just going to use for this example a 5% growth year over year. So what happens in year one, your house is going to be worth about $250,000. And what's going to happen is it's going to have this uptick in home value. So again, if you wanted to sell the home in year 10, you're going to get a lot more than $250,000 in most cases. But what this does and what this shows on a visual scale is that everything between what you owe the bank and what that house is worth is considered equity, right? This is the money that would go into your pocket if you had to sell the home and what was left over. Now, if you're making extra mortgage payments, of course, you're going to get more equity because you owe less to the bank. So at any given moment, if you wanted to sell your home, you have an increase in equity. Now, think of that $500 extra payment. What happens in this example is that money, that extra $500 goes directly towards the equity in the home, the value, the amount that you have in the home. If you wanted to pull that money out at a later date, you'd have to refinance. It's not exactly liquid. Of course, you would have more in that term of equity than you would if you did make the extra mortgage payment. But what happens is, in order for you to get that money out of the home, you're going to have to contact your lender, refinance, to get cash out. So that money is pretty much tied up in the real estate of the home. If the value of the home goes down with the market or up with the market, consider that extra mortgage payment an investment into the property. Now, it's great because we do want to get out of those interest payments. We do want to pay off the mortgage. That's the ultimate goal. However, I'm going to show you if we had another vehicle. In this case, we have an insurance policy that we're going to take that $500 and we're going to put it into a cash value insurance policy. In this case, it's an index universal life plan, an IUL. So getting back to the visual, what if so we see that the home value is going to increase over time. By year 30, the original payoff date, home is estimated to be worth about $1,080,000. Now, the equity that you have with this accelerated payment is greater, and this is what it looks like. If we compare that to the original mortgage payment, this red box, right? No extra payments here. The value in the equity, you can see in year one, it's $1,150. It's obviously going to be more with the accelerated payment because you're putting more towards principal. $25,000 in year two versus $17,000, $48,000 in year three versus $34,000. And what this is that's that extra $6,000 that you're putting towards the principal balance of the mortgage. So you can see it in this chart. If I look at 2032 with the accelerated schedule in 2032, it's about $217 that you have in equity. If you did that 2032 without the extra payments, it's about $155,000. So you can see that equity gap is a lot bigger with the accelerated payments. But if I'm not putting that extra into the home, if I'm not investing in the home, then what do I put it in? Well, in this case, we're going to show you putting it into an IUL. So we're going to take that $6,000 a year and we're going to put it into a product that's going to gain cash value and grow over time in a compound interest account. And the beauty of this is the death benefit. That's the first plus. At any given moment, if you were to pass away along this schedule, then the death benefit is adequate enough to cover the balance of the home. That's one value. That's one value add by having the IUL. If you were to pass away, traditional mortgage schedule, you pass away, say in year 6, you'd have to still owe the bank $228,000. In this case, with the IUL, a $285,000 death benefit covers the $228,000 that you owe, and the house is paid off, and the family has a little bit of extra to just move on and get on with life. Now, when we put that money in the IUL, what we can see is a couple things at work here. Well, first off, we don't want to put the $6,000 a year for the next 30 years, right? That wasn't the point. The point was to pay off the home sooner. But what we're doing here is we're also building a cash value equity in this IUL. Just like the home, the value of the IUL goes up. It's an indexed universal life account, so it's indexed to the market, so you get market returns. The market crashes, your money's protected. It's an insurance policy. There's what they call a floor. You don't lose any money. It's not like an IRA or 401k where you can have a market decline. So this shows you just a general projection of what your equity would be in your IUL. Now, what we want to do here is we want to look at now the two policies as they go hand in hand. So we're looking at the equity again, 2032, 155,000. Now we have about $60,000 in equity in IUL. And so total equity at this point is about 214,000. Now, keep in mind with this IUL, if I were to pass away, my family would get the $310,000 to pay off the $214,000 that they earned, roughly getting about $96,000 in excess funds. But in this case, $214,000 in equity, total equity between the IUL and the home. They're both gaining in value and they're both compounding. Now, again, we don't want to keep the IUL for 40 years for the purpose of paying off the home sooner. What we want to do is we want to use, as soon as this equity gets to a value that exceeds what we owe on the home, then we want to pull the money out of the IUL, give that money to the bank, pay off the home, and now we have the mortgage paid off. So what happened is I just took in year 18 again, in 2041, what happens is our cash value in our IUL is in excess of what we owe on the home, 161,000. And in 2041, the balance is 153,000. So we're going to take a policy loan of 153,000, take a check right out of our IUL, we're going to give it to the bank. Now, what happens at that moment is it pays off the home, right? So at this case, we have 153,000. We would put 250,000 towards the home. Our balance would drop to zero. Our interest would freeze at 190,000. And at this point, we wouldn't owe any more money, right? So let me just fix some of these calculations here and pull that down. Now what happens is all of these extra payments would go away. We wouldn't need them, right? So what would happen here is now when the house is paid off, our equity is now equal to what the home is valued at, right? We don't owe the bank any more money. So instead of it being less, it's exactly equal to whatever the value of the home is at that time. So now what we want to look at is we want to look at what happened to our IUL. Well, we pulled the cash value, we pulled the equity from the IUL and we paid off the bank, which is great. But now we're not going to continue to make, you don't have to, but you don't have to continue to make premium payments. At this point, you have a paid up life insurance policy, and it's going to continue to pay an interest on the account value, and your spending power, your borrowing power in this column, the equity that you have in the policy is going to continue to grow in most cases. In this case, what happens is without any further premium payments, by year 30, the original payoff date, there's an additional $73,000 of equity in that IUL. So your total equity at this point is not only the 1.08 million that the home is valued at, but it's also including the 73,000 that you have in the IUL, leaving your total equity to 1.153 million. So let's look at the grand scheme, like the whole picture. This is what happens when you pay off the home. Your total equity in year 30 is 1.153 million instead of 108. And side by side, I put the accelerated payment schedule because I do want to highlight the benefits of that, saving $122,000 in interest. When we use the IUL method, we're paying more in interest payments. Instead of paying 126, we're paying roughly $190,000 in interest, which on the surface looks like it's a worse deal. However, remember that the IUL is gaining equity while we're funding it. So what happens is we're actually making money in the first 18 years. And you can see that if you do 18 times 6,000, you're coming up with 108,000 over the course of 18 years, but our value of our life insurance is 164,000. So I put 108,000 in it because it gained equity for 18 years. The value projected to be about 164,800. And so we made that 56,824. We used our money to make that money. And what happened was is we paid the bank off in the same year, right? So if you look at them side by side, I can either give the money to the real estate or I can give the money to my IUL. The beauty of the IUL is this equity is accessible. If at age 45, you have $132,000, it's like a savings account. You could pull that money for expenses or for emergencies. It's tax free. And in this case, for the purpose of paying off the mortgage early, we paid it off in the same year, right? But the beauty of this is the IUL is going to continue to grow in equity, even though we're no longer funding it. The same dollars came out of your bank account. Instead of going to the real estate and being locked up in the real estate, you put it in your IUL and you maintain that liquidity throughout the IUL. But again, don't forget, you have the death benefit that protects the mortgage. The mortgage is protected. The liability is protected the entire time. You have the peace of mind knowing that your $500 is not only going to the lender, it's going to yourself, keeping it liquid. And, oh, by the way, if you pass away and don't make it to pay off that home, the IUL policy is going to cover that home. So it's not really the same thing. It's a huge value add to be able to have the IUL. Because what happens in year 30 is our total equity in year 30 is 1.153, as opposed to just making the extra payments to the mortgage. Your total equity in that home is 1.08. So you're actually making about $70,000 more in this case. But wait, it doesn't stop there. Nothing says that you're going to pass away at 60, 61 years old for this example of a 30-year-old female. What happens is at age 65, this particular female would have 211,000 of paid up life insurance. If you made just accelerated mortgage payments, you would have no paid up life insurance. At age 70, this particular individual would have 270,000 of paid up life insurance versus the accelerated putting your money towards the lender, you would have zero life insurance. So not only do you have the mortgage liability protected with the IUL contract, but you also have that equity growth forever, the life insurance down the road, the borrowing power and liquidity throughout the entire process, plus chronic illness, critical illness, and terminal illness protection in the amount of this death benefit. So if you didn't think that that was enough, one of the biggest benefits here is also the ability that now that that mortgage is paid off, if you're still working and you needed an account, you wanted to duplicate your money, you didn't want to just put it into savings. Right now at 50, 49, 50, 51 years old, you want to put it into a safe investment. What happens if we put, say, $1,000 a month into this IUL to get that equity snowball rolling again? Is it would extremely increase the value of this equity. Notice I went from 19,000, I added 120,000 over 10 years, and now I have 217,000. So I'm duplicating my money. And at this point, when I hit retirement, I don't have to fund it anymore. But my equity in that life insurance policy is going up a minimum of 20, 22, 23, 24, $25,000 because the compound interest on the account value continues to do that for me. In this example, I call this pay off the mortgage, but then accelerate your retirement, right? Fund your retirement, right? Put more money into a safe account that's not going to fall for the market in any given year. And given this example, the total equity in year 30 would be 1.35 million. Paid up life insurance at 65 without making any additional payments would be 625,000. Paid up at 70, 720,000 without making any additional payments post-retirement, and having a liquid amount at age 70 of about 555,000. Not to mention, let's see what the house would be worth at age 70. Right. So you look at all the assets you would have given this, you would have about 2.231 million, the value of the home plus the $555,000 in equity in the IUL. Again, without paying anything after retirement, 2.231 million as opposed to just having 1.6 million. To me, in a lot of cases, the IUL is a no-brainer. Having that money liquid for you, having it work for you the entire time and not just giving it to the lender Not to mention, and I don't get into it because I'm not a tax professional, but I'm pretty sure that you can write off the interest that you pay on a mortgage loan. So in the years when you're paying heavier interest, it's more that you can write off on your taxes in your early career. Whereas funding the IUL and allowing that time to grow and compound for you can make you money over the long run, a significant amount of money while still saving you tens of thousands in interest. I know this went over. There's a lot to unpack. That's why I created this video so you can stop it, pause it, you can rewind it. But at any point you want to see an example for yourself, feel free to hit the learn more, send a private message, or click a link to book a one-on-one where we can unpack your mortgage payoff, get you paid out of that mortgage a lot sooner, start to build that paid up life insurance for you, keep the long-term care chronic illness riders intact the entire time, having that mortgage protected, keeping your money liquid, and giving you the peace of mind knowing that you're either going to fund the dream, live long enough to do so, or heaven forbid something happens, the family gets to carry out that dream in your stead. My name is Jonathan. Thanks for hanging out, and let me know how I can help. Take care, and until next time, stay safe.